Wall Street has had a turbulent year so far, and as a result, some traders are concerned about extreme scenarios that could engulf the $23 trillion Treasury market. The first is a fresh bond sell-off due to excessive inflation, while the second is a sustained rally that brings rates back to historic lows due to worries of a recession. The stock market has also been in a downward spiral for some time. The S&P 500 index has fallen 23% from its peak on January 3, while the NASDAQ has fallen 33% from its peak on November 22. However, many of the largest high-flyers peaked in February 2021, some 9 months before the NASDAQ peaked, and have subsequently fallen by 70%, 80%, or even more than 90%. And it occurred rapidly, stock by stock. These equities began their consistent decline 9 months before the NASDAQ began to decline. Hello and welcome to Smart Tech Ideas. In today's video, we will talk about the collapse of so many stocks and top companies in 2022 and the potential reasons behind this massive crash. If you like the video, don't forget to give it a thumbs up, subscribe to the channel, and turn on the post notifications. So without wasting any time, let's dive right into the video. After many years in existence, what many of these failing companies have in common is that they continue to incur substantial losses. There are a few profitable businesses within this category, but the majority are losing a ton of money and have begun laying off employees. Another thing they all had in common was that these stocks hit absurd peaks, mind-boggling peaks that would make any sane person exclaim, "This garbage is in a preposterous bubble." Wall Street and everyone else overhyped them to the nth degree. Uber, Spotify, Snap, Pinterest, Zillow, Redfin, Opendoor, MicroStrategy, Twilio, AMC Theaters, Chewy, Virgin Galactic, educational platform Che, and auto insurer Metromile are on the lengthy list of stocks that peaked in February 2021 and have since fallen by 70%, 80%, or even more than 90%. Metromile went public via SPAC in February 2021, and that was its peak. Since then, it has collapsed by 96%. There is Zoom Video in this group. It has decreased by 76% since its absurd peak in February 2021. However, it is one of the few profitable enterprises on this list. Cathie Wood's ARK Innovation ETF, which follows a number of these hype and hoopla firms, similarly reached its top in February 2021 and has since fallen by 76%. And this occurred as the major indices were still lurching from new high to new high. Propelled by the largest stocks, the Federal Reserve was still creating money hand over fist and inflation had begun to rise. However, this noise below the surface indicated that something had cracked. So what occurred around February 2021 that drove investors to quit these stocks? While the Federal Reserve was still producing money hand over fist and repressing interest rates, and while the third batch of stimulus checks were being prepared to be mailed out in March, inflation suddenly spiked. And all of these inflation concerns were forcefully dismissed by the Federal Reserve, the media, economists, and most vehemently by Wall Street's hype and hoopla. Sooner rather than later, inflation would get so bad that the Federal Reserve would be forced to crack down and would be forced to raise rates a lot, and quantitative easing and begin quantitative tightening, and everyone knew what that meant. Stocks would spiral down because this entire stock market bubble was a result of money printing and interest rate repression, and to some extent, all that stimulus cash that the government poured into the economy. Without these factors, stocks would be worthless. Not only this, but ARK Invest's CEO Cathie Wood has also sounded the alarm on a potential recession in the US and a big slowdown in China in her firm's quarterly report. So what do you think is happening behind the scenes that is causing this massive sell-off? Tell us in the comments. Also, don't forget to like and subscribe. See you soon with the next video. Thank you so much for watching.